You're listening to Storage Nerds Podcast, where we unravel the best-kept secret of the real estate investing world, the storage industry. Join the grassroots guru in self-storage, Stacy Rossetti, in insightful discussions about finding, funding, and running these spaces, allowing you to yield the highest returns possible. Get your foot in the door on self-storage and discover how to properly purchase facilities, negotiate with sellers, and close the deal without worries. Start unpacking that investment wisdom with Stacy right now.
So today it's going to be talking about financing, and I had a couple of emails over the past couple of weeks asking about the financing and the funding and what's going on with the market right now. And this is a very, very big topic, and so I figured I would just talk about it and go over it. But the truth of the matter is that, money is expensive right now. Money is very, very expensive. So you have kind of two qualifiers. You have one of them is commercial real estate in itself is expensive. It's not cheap to buy commercial property. And, so that's always been that way. That hasn't changed. It's just expensive to buy commercial property. And then on top of that, now you have the money that you're borrowing and the money that you're using to buy the properties is also expensive. And so you just have these two big factors in the market really screwing up how deals are played out. And so understanding financing right now and understanding, what we're doing internally to help our students get deals under contract is like key, because if you don't understand these things, then you're really not going to be able to buy a deal. And I'm telling you right now that I am seeing more and more people bow out of getting into this niche, or even getting out of this niche if they got into this niche. So we have 15 virtual assistants that do nothing but call owners and make offers. Not me personally, but my team has called every storage facility in the secondary and tertiary markets, every storage facility in the country. And we've asked the owners if they are open to getting an offer. All right. So now think about that. I'm your competition. Right, I've got 15 people working for me doing nothing but making offers on properties. Now, the truth of the matter is like when you call an owner and talk to an owner, then it's just a numbers game. That's all it is. It's just a numbers game. And it was a numbers game. It was really not a numbers game. I would say like maybe 5 to 7 years ago when I was calling owners and talking to owners, it was like so easy to find storage facilities. It was awesome. It was like the best time. Like when nobody was thinking about storage, I was buying deal after deal after deal. All right. And then COVID came. And once COVID came into play, like everything just changed in the last couple of years. And everybody was moving from like residential over to commercial, and they were either getting into multifamily or they're getting into some sort of commercial aspect in the industry, which people are still doing right now. I'm sure a lot of you guys listening right now, you guys were in residential, and residential is too difficult. So now you're looking for another niche to get into. And so this is like typical story. But the truth of the matter is over the course of the last couple of years, what happened is that interest rates, so from like 20, okay, so let's do 2015 to 2019, interest rates, were like where they should be, honestly. Interest rates were like 5% to 6%. In commercial real estate, that's kind of where you want to be, right? And the down payment was like 20%. So when I was teaching people how to invest in self-storage back in these years, I was just saying like it's the 80-20 rule. Just think 80-20, 20% down, a bank will finance it. You'll get anywhere from 5 to 6% interest. And then you can run your numbers that way. Okay. And then of course, COVID happened. So 2020 to 2022, right? So that's when the interest rates all went down. Okay. And then so it was like what, 3% to 4%, let's say, right? And the down payment kind of stayed the same. It was probably around like, I would see, and actually it just depends on what type of loan you get. I'm putting this down as a conventional loan, okay? If you were getting an SBA loan, then you would have like 10 to 15% down, depending on your experience, okay? Or the asset itself. But so this is kind of what we saw in like 2015 to 2019. And then in 2020 to 2022, then it started to be like 15 to 20%, let's just say, right? I rarely ever saw a deal where somebody wanted 25% down. You know, and this was a conventional loan. And then SBA is always 10 to 15% down. Not always, but say typically 10 to 15% down. Okay. But the interest rate was at like 3 to 4%. Okay. But what happened is that the prices for properties were like, the cap rates were higher. Let's just say that. The cap rates were higher. I could find, you know, properties for like 12 caps or 10 caps, you know, out in like secondary and tertiary markets, right? But then during COVID, the cap rates were low. I guess it's cap rates, if you go lower, is it lower? Like if it's 4, is that a low or a high? I don't know what that is. Y'all tell me if y'all know. But cap rates were like, so let's just say cap rates were upwards for secondary and tertiary markets. They were upwards of like, I could buy my properties. I was teaching to buy double-digit cap rates. This is what I was teaching. It's like, look for double-digit cap rates. All right, so let's do double digits. Okay. And but then, and all of my first 12 properties were double-digit cap. I mean, I'm making like amazing cap rates. I'm like upwards 25 to 30% cap rates on my deals. Okay, and that's how good they were. But cap rates now, like in the 2020 to 2022, like all of a sudden we're like super low high. All right, and so that means that it was like less than 10%, but typically like I would say 5 to 7%. Okay, actually let's just do that. Let's do 5 to 7% cap rates. And so, and the cap rate is just basically like the value of the property. It's really your purchase price minus your income. I mean, sorry, the value of it's the value of your property based on what the market calls for. And every single market is different, and cap rates are always different. And honestly, the truth is cap rate is just kind of it's just a way for you to calculate what the market, that market that you're in, that number, that valuation is worth. Okay. But so you don't want to get too deep into that, but I'm just telling you that the cap rates were very low, or even lower sometimes. I should put lower. If you're in a primary market, it was like 4. Let's see. Okay, that's 2020 to 2022. Okay. And then, right, and then like 22 to 23. So let's say 2023, this year. Okay. 20 is so then obviously like interest rates are like way up. Okay, so now interest rates towards the end of 2022 to 2023 started going really way up, and now they're at like 8% or up to like 12%, depending on where you're at right now. Okay, I'm going to get into all this. I'm going to just give me this time to explain it before you start going like crazy with like, I don't understand what Stacy's saying. Just give me this 30 minutes to explain this. Okay, so interest rates, obviously we know interest rates like super high right now. Okay, and the down payment is around 25% to 50% down. This is what banks are asking for. Okay. And this is a conventional loan. right? And then an SBA loan is still the 10 to 15% down, but the interest rate is like very high. Okay, the interest rate is like 10 to 12%. That's why I said 8 to 12%. Okay, so interest rates are going up based on what the Fed calls for. The Fed says the numbers are going to be, right? So now if you think about this, okay, so we've got the last, like, whatever, how many years this is, the last amount of years, the last 8 years that I've been doing this now, okay? The market is very cyclical, right? It was up, it was down, it was going up, and now it's going back down. And what happens in a down market is that there's typically, it's harder to find money and there's more properties to buy, okay? It's harder to find money and there's more properties to buy. So you're looking like this, right? And so this was like 2008, right? And here's like 2015 and then 2019, and here's 2022, and now we're like 2023. Okay, and we're going down, and we are still going down. Typically, this is supposed to be an 8 to 10 year cycle or something like this. Okay, but so it kind of looks like that, right? I think it was like 10 years. Y'all, if you guys are not agreeing with me, just yell at me in the comments. Okay, it's all you have to do. But all right. So that means that how many years are we going to be in a down cycle? When did the down cycle start? I don't know. I would say 2022, 2021. But how many years are we going to be in this down cycle? So people are asking, like, how long is this like crazy chaotic market going to be for? Well, typically down markets and up markets are like 8 to 10 years, right? So, we could be in this down market for a long time, right? Now, but the question is, when is the interest rate going to get to 5% or 6% again? That's the big question, which is a good interest rate to be at, right? Or are we going to be stuck at this 8%? Are we going to be stuck at a number like for a while? So that's the big question of the day, not only for residential property, but also commercial property. So when you think about whether or not you want to get into this market, you have to decide, like, am I willing to pay a high interest rate for a property, right? And if so, what are my personal parameters? What are my guidelines? What are my boundaries for buying a property? And so when I talk about people that are bowing out, a lot of people bow out on the downturn. And the reason why they bow out on the downturn is because interest rates are so high. And the down payment, all right, the down payment is up. So it's very, very hard for people to come up with 30% down or 40% down or 50% down, which that is what a lot of banks are asking for, because the banks want to basically, they want to protect themselves. They want to make sure that the asset is safe. Okay. So I'm seeing, like, just this year, it just started happening this year, that a lot of people are getting out of storage investing. And maybe, I don't know about all of commercial real estate marketing, but definitely in storage investing over the course of like this time frame right here is when everybody was like, oh my God, yeah, there's like storage facilities in the world and I should be investing in them, right? And so everybody's like, went out and like went crazy, bought a whole bunch of storage facilities. And what happened, remember, during this time, so in like these periods here, okay, in these periods right here, the prices changed, right? The prices were like pretty low, honestly. Low prices, low purchase price. Like I amazing deals in this period. I got very, very good deals on property where I now, because the market went up so high, I'm tripling or quadrupling the property's values of what I purchased during these years. And then, but then what happened is the prices of property during this time, of course, obviously we know it's like super high prices, right? Okay. And so, you know, and so now you've got all these high prices with these low interest rates, right? You've got like good normal prices, good prices with like good, you know, interest rates. Like you want to be like this 2015 to 2019 years. This is where you really want to be in the commercial market. And this is kind of a good like interest rate, down payment, the cap rates were good. The prices of the properties were good. Like we want to be in this area. And then here we went really high with low interest rates. And everybody's like, oh, I got a 3% or 4% interest. Let's just go buy whatever, you know? And they really were not paying attention to, you know, like how many storage facilities were in a location. Right now, the big question is your location oversaturated? So when you're looking at a property, you want to make sure that there's not too many storage facilities in the area, because the way that you really calculate your storage facility is, you know, whether or not a storage facility is going to make money is by, it's called net capita per square feet. And so then like you want to calculate all of the population in an area and then the total amount of square footage in the area. All right. And then you want to divide that and then you want to come up with this number. It's like a whole formula, right? But what's happening is that there is saturation, a lot of saturation in certain areas. I would say most of the saturation is going to be in your primary market, and then some saturation in your secondary market. Tertiary markets don't have a lot of saturation, but it's getting to the point where you still want to know, is there too many storage facilities in this little tiny town compared to how many people are living in this town, right? If there's too much storage and there's not enough people, then obviously you're not going to be able to make money, okay? And actually, when you talk to banks, like this is one of the things that they're looking at. I mean, they're looking at feasibility. They're looking at how many storage facilities are being built in this area. And then within the next 2 to 5 years, are you going to have too many storage facilities in this area? Because this is a major concern. And that is because of, you know, this crazy building time and all the stuff that happened in the last couple of years. So now we're in 2023 and interest rates are 8 to 12%, depending on what type of a loan that you get. And so when your interest rate is this high, then you have to make sure that your purchase price is at the right price. And so the way that banks work, right? You have conventional loans. And then you also have SBA, which is typically the two kind of ways that you're going to fund secondary and tertiary market deals, like less than $2 million or say less than $3 million. You're going to kind of go this way, right? Now, when you get into like bigger facilities, you could do like commercial mortgage-backed securities and stuff. But we're like, you know, we're little people. We can only afford so much. And I'm going to show you how to get your foot in the door. And typically, you're going to be going through one of these two options on the bank side, okay? On the bank side. So on the conventional loan right now, and what I'm seeing is, again, 30% down, 8% interest. We are running our numbers at 30% down and 8% interest. Okay. We're running our cap rate, the market cap rate, at a 7. Okay. And now, you know, in a primary market, it would be different. And then in a tertiary market, really, honestly, for a tertiary, secondary, and tertiary. Okay. Markets. That's where we're at. We're going for a 7 cap is what we're doing. And then on top of that, these are fixed loans. So they're not changing, like this is it. And the terms are typically, it's a 5-year balloon. And it's like amortized over 20 years. Sometimes you can get 30 years, but it's like the amortization. That says amortization right there. Okay. Hang on, let me get that. Now, so amortization is like, oh, let me just try to like spread that mortgage out over like 20 or 30 years. So I can make that mortgage as small as possible. That's what I'm talking about. Okay. And you'll have a balloon. And so this is a typical conventional loan. So when I say conventional loan, if it's under $1 million, under $1 million, then you're going to go with a local bank. Okay. And if it's above $1 million, you could still do local, or you could do nationwide. Okay. Because nationwide banks, like they really just want like bigger deals. They don't want like smaller. Most of them, I'd say most of them, like they always say they could do a smaller deal, but in the end, they don't want to do smaller deals. Okay. So typically what I tell my students is like, if we find an $800,000 deal that we want to buy, I just say, just go talk to your local bank. A local bank is going to be like a community bank. It's like, or a farm and land bank or farm and trust, or, nothing like Wells Fargo or Bank of America or something like this. Okay. You're going to just do like in that town or in that area, just the smallest bank that you can find. They love storage facilities. Okay. So you want to make sure that you're talking, like if you're interested in an area and you're like, look, I only want to buy something in my area, then you should really be talking to every single bank in your area that's a local bank and saying, look, I want to buy a storage facility. Do you fund on storage facilities? And if so, what are your terms? And then you can just keep track of all the banks that you talk to and all the different terms, and so the thing about commercial real estate is commercial real estate is asset-based lending. Asset-based lending is, it's based on the income of the property. How much money can this property produce? Because they're basing what the mortgage is going to be off of how much money that property can produce. That's how commercial real estate is. Now, you as the person, they may check you out, and stuff like this, but typically it's like asset-based lending. Okay. So you could just say like, look, I want to buy a property, I want to buy a storage facility. What would be the terms typically that you're using to invest, to fund, storage? And they can give you the terms because they say, look, for storage, we're typically at like, prime +2 or whatever it is. Okay. All right, so that is conventional. That's conventional lending. And this is how we are running our numbers. So if you buy the deal analyzer and you go to the financing tab, right? There's a whole bunch of tabs at the bottom. And the financing tab, there's a way for you to run 5 different offers at the same time. We do cash offer, creative deal structures, bank financing, and private lending. And so with the bank financing, you will just put 30% down, 8% interest, 5-year balloon over either 20 or 30 years amortized. So that when you're running your numbers, you can make an offer on this. Now, another thing with banks, okay, and this goes for like any type of bank, is what they look at is what's called the debt service ratio. And the debt service ratio is like, I don't know, some way that they compute like how much money they can lend based on what the value of the property is. Okay. So however they do it, but they typically want to be, right now, they want to be at 1.3. Like I have talked to many, many banks and looked at many deals over this entire year, and banks are requiring a 1.3 or higher now. So you've got to, when you run your numbers, your purchase price, the main thing that you have to do is make sure that your DSR is at 1.3. Banks will not fund a deal right now unless it's at a 1.3. It's like super tough. maybe you might find a diamond in the rough, but like we've seen banks over and over just saying, I'm sorry, but like, no, you need to have that income higher or the purchase price lower. Okay. So it's a 1.3 DSR. When you're running your numbers for commercial deal analysis, make sure you get this. If you don't use my deal analyzer, whatever deal analyzer you use, you want to be at a 1.3 DSR. And you want to be at 30% down at 8% interest. And what I'm telling my students over and over and over again is that whatever the purchase price is, that equals that based on the income, right? So you're going to put your income in. So, and your income and your purchase price. Whatever the income is and whatever purchase price that you come up with have to equal a 1.3 DSR with 30% down and 8% interest. This is where I would be running the numbers. And if you guys are seeing something else, let me know. I would love to know in the chat if anybody's seeing anything else. But for me personally, this is where we're at with the banks. This is what we're seeing on all the offers that we've put out. We've got a lot of offers out in the last couple of months. And this is where the banks are coming back at. Okay. All right. That's conventional loans. Okay. The next thing is SBA. Okay. So SBA is like, the small, what's SBA? The Small Businesses of America or something. I don't know what SBA sounds. But so SBA is a government-backed agency that loans to small businesses. Any type of business, but they love storage facilities. Okay. And so a lot of people get SBA loans. And what is really enticing about an SBA loan is that they want 10 to 15% down. Right? So you don't have to put that much money down in order to get an SBA loan. Okay. So people are like, oh yeah, like I could just go buy this $1 million property and, I only have to put 100 grand down. That's awesome. I would love to do that. Right. But the thing is that they have variable rates and it's all based, not variables, variable rates. And it's all based on like what the federal government is telling you. And it could be prime plus 1 or 2 or 3 or whatever it's at right now. But typically for SBA, I'm seeing rates between 10 and 12%. Okay, like we have a student that got literally is like 11.99% loan, which back in 2015, when I was in 2015, where's that at? Right here. Back in even 2010 to 2015, you were up in the high like 10 and 15% bracket. And you remember that, this time from 2008 to 2015, what was happening is that there was no financing or very little financing and lots of properties for sale. Right. And so if you wanted financing, the interest rate was super high. Right. So that's basically what was happening on the upswing from the bubble. Right. There was a lot of properties for sale, but there was no banks that wanted to finance them. Right. And so now we're getting back into this. There's going to be a lot of properties coming up. There are 800 there's 800 storage facilities for sale on Crexie right now. 800 right now in 2023. And when I got in 2010 to 2015, when I got into storage at 2015, there was like 200 storage facilities for sale. That was it in the whole country. And now there's like 800. So there's a lot of properties for sale. So when a lot of properties are coming in, you'll know that we're getting back into this cycle. We're getting back into the cycle of a lot of properties for sale and no financing or very little financing out there. Or I could say maybe expensive financing, right? It's going to be expensive financing, right? With lots of properties. Okay, so that is where we're headed. This is where we're headed. It's going to be expensive to buy a property. So if you want to get into storage right now, I don't mean to I'm not trying to scare you off. I'm trying to be honest with you. Like you need to have money. you need to have money, either your own money or you need to get somebody else's money to buy the property. And then also what you have to be really, really good at is you have to be good at running numbers. And you have to know what the DSR is going to be. In SBA, this must be a 5. SBA, it's 1.15, the DSR, okay? So you can have a lower DSR, which means that your purchase price can be higher, and you know what I'm saying, but you want to have like a big enough spread in the deal, be like on the back end for your opportunity cost. You need to have a bigger spread for SBA loans to work. So you really want to be at like a 50%, like 50 cents on the dollar, maybe 60 cents, but I say 50 to 60 cents on the dollar or less. So that's where SBA loans. So for instance, like we bought a facility in May of this year in Tennessee, and we bought it for $2.4 million, and it's valued at like $5.5 million. Right. So I really bought it like 50 cents on the dollar. I mean, it's a huge spread. And we actually got an SBA loan, and we're paying like almost 13% right now. So that's like, you know, it's just like a hard money loan, really is what it is. And, you know, as the rates go down, remember, it's a variable rate. As the rates go down, our interest rate will go down. But is that going to happen in this time frame? And we have our loan, like we're only going to hold on to this property for like 3 years. So in 3 years, are we going to be able to get to 5 to 6%? No, probably not. My personal opinion, I don't think it's going to go down that fast. And so then you have to make sure that you're running your numbers so where it works. That's why you need such a big spread. All right, does that make sense, everybody? I hope this is making sense, everybody. And so make sure if you want, and we bought a $2.5 million facility, and we had to put like $350,000 down. And the reason we had to put $350,000 down is because we put 10% down, which is the $250,000, but the fees for SBA, that was like almost $100,000. I think it was maybe at least $75K. In fees. It was a lot. I was like, oh my God, that's a lot of fees, my God, for this SBA stuff. On top of that, so not only are we putting only 10% down, so we bought a $2.5 million facility for like $250,000, right, or $350,000, but we had to pay $75,000 in fees. We had to make sure that 13% interest rate worked on the cash flow. And guess what? It don't work on the cash flow. Like we are having to come. We have a mortgage of like almost $20,000. It's like $17,000-$18,000 a month. So you know we're having to make sure that we're making that much money, which we're not because it was a severely mismanaged facility. So we're having to come out of pocket every single month until we actually stabilize that property. And on top of that, there was a whole bunch of CapEx that need to get done, and you know, so we're in the hole right now on that property. So if you want to get an SBA loan, these are very, very good for mismanaged facilities, and they're called projected based loans. Projected based, which is what we got. And so we gave them a proposal and say, look, we're buying this for $2,500. We're running our numbers at like 2.5 million. We're running our numbers at 5.5 million. So there's like a huge spread on this deal. We can afford, 12, 13% interest, but we're going to have to put a whole bunch of CapEx into this thing. And we're going to have to come out of pocket for the first like 18 to 24 months. So this is kind of like a proposal that we put together to SBA. We convinced them to give us the loan, and they did. And so now we're coming out of pocket till we stabilize this property. And so what happened? How did I afford that? Essentially, I raised $900,000. So I raised enough money to afford our mortgage for like 2 years. And on top of that, for the money that we put down to close, and on top of that, also the CapEx that we needed. So I raised like 900 grand or more. I can't remember what it was, but you see what I'm saying? So that's kind of how that worked on that deal. And SBA will not work for a deal that's less than $1 million. So if you're looking at a small deal, like it's just, small deals are going to be very, very hard to fund with an SBA loan over the course of the next couple of years. To hear back, I mean, used to hear in 2020, I mean, all those SBA lender brokers, think how busy they were. It was like they were so ridiculously busy because they were doing this 3 and 4%, right? So they, like, people were just like getting loans after loans after loan. But guess what? If you got an SBA loan in 2020 to 2022, you have screwed yourself over because your interest rate is now 12%. Right? Because remember, SBA loans are variable rate loans. So you're betting in 2020 to 2022, you're betting on a 3 or 4% interest rate. And on top of that, you're betting on all those rate increases. Because you remember all the units were like, you know, it's like $50 a month, and then went to 60, and then to 70, and to 80, and 100, and 150, and 200. And you're like, yeah, I'm making so much money. And you made a lot of money. If you bought something in 2021 or 2022, you made a lot of money on those facilities. Now, all those people, they all want to sell their deals from SBA, betting on 4% and a high income. Not happening. Because now in 2020, the downtime, right? Now going into the downtime is screwing everybody over. So you will see, that is why all of those properties are on Crexy right now, because they ran their numbers in the wrong way and they screwed themselves over. But those properties are very, very hard to fund because they bought those properties at such a high purchase price, probably the wrong purchase price. And now, like, they're having a hard time selling them. So they're going to screw themselves over. So because of that, the down cycle is going to be very, very interesting, you know, to see what happens, you know, but it's going to be a lot of opportunity if you can truly understand how to finance, all right, properly. And then on top of that, understanding how the banks are working right now and understand, and then also, where are you going to get this? Because that is key. That is key. So if you want to buy $1 million property, you need $300,000 to buy it. Okay. If you want to buy a $500,000 property, you need $150,000, $200,000 probably to buy that. We have a couple students that, like, we found really amazing deals for like $700,000 to $800,000, and the banks want $275,000 down to buy those. I mean, and they have 100 grand or 150 grand, and that's it. And you think in your mind, like 150 grand should be able to buy a $700,000 property, but it doesn't right now. It doesn't. Okay. So that is really like, that's really how the market is. And so I want to make sure that you are running, the purpose of today's exercise is to make sure that you're running your numbers properly on your deals, and that when you make your offers, you're using the right terms in the, you know, in your inputs for your financing. If you have to go to a bank to get a loan, all right, this is the formula to get a loan. And somebody's asking, Steve, what's the typical flow on $1 million property? I don't know. Every $1 million property is different. What if it was only making $25,000? What if it was making $50,000? What if it was making 75? What if it was making 100 grand? There's no way, like, you can't ask a question like that, not to be rude, but you can't ask a question like that. You know what all of the deal are, okay? So what I would suggest, Steve, is to practice putting offers in, go on to Cruxy, look at $1 million deals, get all the information from the broker, put it into the deal analyzer, and then start really familiarizing yourself with how the numbers work and then put your bank financing terms in, if that's how you're going to have to finance it, so you can start getting a feel for how analysis works. And the analysis that I did 2 years ago is completely different than from now. The analysis that I did 5 years is completely different from now. So as you go through this cycle, as you go through the market, you are really educating yourself on what does financial analysis for a property look like on an upturn, on a high point, on a downturn. All right. And that's really what you're looking at. Okay. All right, so conventional and SBA loans were the two things that I wanted to talk about today. And then, and then somebody says, Elisa says, what is your minimum goal in terms of cash on cash? We are looking at 10% cash on cash or higher. That's where we're at. So we are 10% cash on cash or higher. All right, that's always where I tell my team at least to be. So all of my deals, like, we do not go lower than that. And there's deals out there that are like this, just as long as you make sure that you have your financing inputs in correctly. Okay, that's the main thing. Okay. Now, financing and understanding the banks and what they want. That was the purpose of today's session. But just so you guys know, on the deal analyzer, we run our numbers 5 different ways. And actually, there's more than 5 different ways. There's at least 6 to 9 different ways, but typically it's like 5 different ways. So we do a cash offer, okay, and then we do a bank financing offer. This is how we're running our numbers, and then we do creative deal structures, okay. And the creative deal structure could be a wrap, it could be a lease option, and it could be owner finance. Okay, those are the typical ones. We could do a subject to. The reason I'm bringing this up, all these creative deal structures, is because in a downturn, this is where owners start to get creative. If an owner wants to sell their property, they're desperate to sell their property because they bought it in 2021 at a high price and they have an SBA loan and it's a variable rate loan. They're desperate to sell their property. And the property's worth, let's say they brought it up, they bought it at $50,000 income, and they took it to $100,000 income, right? So they really doubled the value of that property, at least, if not more. And then, so they want to compensate, they want to get that money that they made, they want that equity in that property. But a bank is going to say that property was worth $1 million, but now it's only really worth, with the 1.3 interest, it's only really worth $750,000. We're only going to finance it at $750,000. And the other says, no, I want $1 million for this property. I paid $500,000 for it. I've paid off $100,000, so I owe $400,000 on the property, and I want the property for $1 million. Right? So they could do something like, okay, look, why don't you give me $400,000 down? I'll pay the down payment, I'll pay the bank off, and then I'll just seller finance that $600,000 to you. And I'm seeing this over and over and over again. That would be like a creative deal structure. Or look, I have that's owner finance. On a wrap, it's like, look, I owe $400,000 on this property. So why don't we do a wraparound mortgage, and I will, I'll keep the mortgage in place and wrap a new mortgage around that mortgage. And then you will have to pay 2 different mortgages, one's to the bank and one's to me, or whatever it is. Or even if you're seller financing it, one to the first owner and one to the second owner. And we have that going on right now as well. We have one right now in South Carolina where the owner of the property wants to sell the property for $450,000. He got that property seller financed to him for $350,000, and he paid off maybe in the past, he just bought this in maybe 2 years. So in the past 2 years, he paid $300,000. I mean, he paid $50,000, so he owes $300,000. right? So if you have like, this is like owner one. This is owner two. Owner one, he owes 300,000 to, and this one here, he bought it. This is owes. And he owes, and then he wants to sell the property for $450K. So he's trying to make $150,000 on the deal. Okay. This is the actual owner. So we talked to this owner with the finance. And he was like, yeah, just assume my loan. That's fine. I don't care who pays the loan, just somebody pay the loan. So there's an assumption, right? Which I didn't put on here, but that's assumption. And then this 150K, he's like, look, I will also seller finance this. And so then that means there's going to be two mortgages, one for 300,000, one for 150,000. Right. And I think that he has to put some money down or whatever. But that's basically it. So you can assume a first loan and finance the second loan. Or you can have two mortgages and you could wrap one around the other, which is basically what's going to happen here. So there's like so many different ways to do stuff. And these types of deals, these creative deal structures, every deal is completely different. Every owner has different needs and wants. And so you're just trying to figure out what the owner's like, what do they need? What's the issue? And then you work the deal out and you create a win-win situation on both ends. Okay. You're going to see this more and more and more. These types of deals happen in a extreme financing situation, like what's going to happen next year. Like it's going to get only, I don't know if it's going to be better. I think it's getting better. I'm like super excited about next year, but a lot of people bow out. Remember, a lot of people bow out when this type of stuff happens. If you do not understand these types of creative deal structures, which is what I teach, so make sure you're following me. If you're not understanding this, you're going to miss out on a lot of opportunity, and you're going to be one of those people that's like, I can't finance anything, so I'm out of here. Banks suck, I'm out, which has happened to like many, many people that I've seen. So you have to understand this. And then when you're running your deal analysis, our deal analyzer runs these for you. And then what happens is you hand over an offer letter that has not only a cash offer, bank financing offer, but then also like a whole bunch of creative deal structures. And a lot of times the owner, they're like, whoa, I never expected to get 5 offers. And it's like, oh, but I'll make this much money if I actually do this instead of this. And it starts really to get their mind open to a whole bunch of different scenarios of what they could be doing to really help them in their situation and to create a win-win situation for them and us. So that's why I really push the deal analyzer, and I'm going to push it more and more and more. This time period is when you need to be making a whole bunch of different offers. Whether you use my deal analyzer or somebody else's deal analyzer, this is what you should be doing, because bank financing is so stringent and so conservative. It's going to be very, very hard to get deals done over the next couple of years. So you've got to learn how to do this. You've got to learn how to do that. Okay. All right. That's my 2 cents, and I'm sticking to it. I hope you guys have fun over the next couple of months educating yourself on investing in self-storage. I'm here every Wednesday, right? So I'll be teaching whatever I feel like teaching, and then make sure you get the course and the deal analyzer, and join the Facebook group and check out my websites and stuff. Okay. All right. I appreciate you guys hanging in there till the end, and I will see you guys next week. Take care.
Thank you for joining us for this episode of Storage Nerds. Hope this informative conversation inspired you to go out there and jump into this highly profitable business venture that people rarely talk about. Get more tips on storage space investing at www.stacyrossetti.com. Don't forget to subscribe to the show and leave a rating. Together, let's build that thriving passive income one storage space at a time. Until next time.